insist on having the floor. Go right ahead.
No, after you. I insist.
Good morning, good afternoon, good evening, no matter what time zone you're tuning in from, and welcome back to Sip&Talk.
It's good to be back.
You know, I was looking at the cover art for some of our recent deep dives, and have you noticed we look a little bit too good? I mean, we've really been leaning into the digital filter, haven't we? I'm just waiting for someone to call us out and say, hey, that's not what you actually look like.
Look, I like to call that the idealized self. You could also call it, data smoothing in technical terms.
Data smoothing. I like that.
Yeah. If our Sip&Talkers ran into us at a coffee shop, they might need, like, an AI face scan to confirm it's actually us. We might have created a little information asymmetry here.
Hey, I just like looking good. Who wants to see the actual, deep, dark circles under my eyes from staying up all night researching these things?
Not me.
While it's not the absolute truth, it definitely makes us happy when we look at it. But, speaking of modified truths, things that look perfect on the surface, that leads us right into the intense topic we're tackling today.
It absolutely does. I mean, our pursuit of the perfect cover image, it's really parallel to the pursuit so many people have today for the perfect AI-generated investment portfolio.
Oh, that's a great connection.
The tutorials, the data sets they show you, they're beautiful, just like your filtered cover photo. But peel back that high-tech filter, and the logical flaws underneath might be deeper than my actual unfiltered black circles.
Exactly. Today, we are dismantling the major flaws embedded in these super popular mental models.
Right.
These are the models that try to use deceptively simple math, the law of large numbers or random walk theory, to explain these incredibly complex social, financial, and career systems.
And you adopt them because they sound so cool. They sound like they can explain everything.
But you might be falling victim to a kind of cognitive beauty filter.
We think we're seeing a mathematical prediction of the future. But a lot of the time, we're just looking at a heavily photoshopped illusion.
So our mission today is pretty clear.
Yeah, we're exposing the high-tech blind men feeling the elephant traps. We're going to show you exactly where simple math just breaks down in a complex world.
Let's do it.
Okay, let's unpack this. We should probably start with the massive successes, right? The outliers, the people like Warren Buffett, their long-term track record, it just seems to prove that certain strategies or maybe certain people are just absolutely superior.
And from an academic standpoint, these models are so appealing because they try to explain all that success using pure mathematical probability.
Right, like the Bernoulli's urn analogy or the law of large numbers.
Exactly. To suggest why some people succeed while, the vast majority just inevitably fail, it gives us this incredibly clean and elegant narrative.
It really does.
If you can boil down massive wealth accumulation to just being on the high end of a predictable probability curve, the world suddenly feels manageable.
Even if you can't predict the specific name that ends up at the top.
Right. And the models will calculate that, say, Buffett's 42 consecutive years of beating the market is such a statistical anomaly. A true 1 in a million event.
That it must prove his inherent skill, his genius.
Yeah.
It has to, right?
And that's exactly where the first major logical flaw hits us like a tidal wave.
Logic flaw number 1.
We immediately fall for survivorship bias, and maybe more importantly, we completely misunderstand the context and the inverse power of the law of large numbers.
Okay, so the model uses that shocking 1 in a million statistic to imply skill.
But let's actually check the math with some global realism.
Yeah, let's do that.
The core failure here is just ignoring the massive, massive global denominator. We're not just looking at 100 people in a room playing a game.
No.
If you look globally, there are easily a million, or you could argue many more, fund managers, entrepreneurs, high-risk investors, all running different strategies, taking different risks.
And sometimes, just randomly choosing stocks based on a hunch or some initial screening model they saw online.
Exactly. So if you have a sample size of 1 million global participants,
then statistics doesn't just suggest an outlier streak might happen.
No, it guarantees it.
Yeah.
Guarantees that 1 or 2 managers will achieve that kind of incredible streak purely by statistical chance.
It's the financial infinite monkey theorem.
It is. We all know that classic thought experiment. Put 1 million monkeys in front of 1 million typewriters, and statistically, one of them is going to produce the complete works of Shakespeare.
Right.
It's the same principle. If you have 1 million Smart, aggressive fund managers playing this highly randomized, volatile game for decades, we are statistically guaranteed to see a Buffett emerge.
Just by random chance, a statistical fluke.
The success is often less about the individual master and way more about the power of the probability distribution itself.
That is such a harsh reality check, because we all want to believe in the hero narrative.
Of course.
But the math just suggests we're observing the predictable outcome of massive numbers. So how did Nassim Taleb articulate this so powerfully in Fooled by Randomness?
Taleb is really the authority here because he just highlighted the acuteness of survivorship bias.
Okay.
We only ever see the winners who survive the volatility and are, featured on the magazine covers. The guys who got lucky enough to stick around for 4 decades.
And we forget everyone else.
We almost instantaneously forget the tens of thousands of equally smart, equally dedicated managers. They might have used the same exact strategy, say value investing, but were simply wiped out by a random, devastating shock they couldn't control.
Like being too heavily leveraged right before the 1987 crash.
Or maybe they got caught in the 2008 housing crisis.
Or maybe they just had one bad year of performance that triggered this avalanche of redemptions from their investors and they were done.
Exactly. They had the same intelligence, the same models, but they hit an unavoidable black swan event and just vanished from the data set forever.
They become invisible history.
Yes. So you, the observer, you see the one successful person who walked through the minefield safely, and you assume his path was entirely safe.
While completely ignoring the 99 others who were excluded on the first step.
Erasing their data from history.
Wow. And let's bring a real-world 2025 reality check into this.
Please.
If Buffett truly believes he has a model that guarantees positive drift and total mastery over randomness, why are Berkshire Hathaway's cash reserves currently sitting at over $300 billion?
That is a staggering amount of idle capital.
It's completely counterintuitive to the master the universe narrative.
Totally. If you had a strategy that guaranteed success, you'd be fully invested, right? You'd be maximizing those returns.
Yeah, of course. That massive cash pile doesn't suggest mastery of the market's mathematical certainty.
No, it suggests a profound, almost paralyzing fear of current market overvaluation.
Mm-hmm.
And the looming potential for a massive negative shock that would make buying opportunities irresistible. He's waiting.
It's a hedge. It's a huge hedge against future volatility, which completely contradicts the idea that his success is a predictable result of some deterministic mathematical model.
So the key takeaway for you, our listener, is this. When the sample size of participants, whether we're talking fund managers, dating apps, or tech startups, is large enough.
Miracles are statistically inevitable.
Yes. Their existence proves the power of large numbers and the inevitability of outliers. It doesn't necessarily prove the superiority of the individual or their model.
Okay, this realization that success can often be just an illusion of randomness, not skill, that transitions us perfectly into our next major critique.
Yes, how the random walk model is misapplied to corporate success and failure.
Right. The model essentially suggests that if a company fails, it's just following a random walk that has reverted back to the 0 point, which is bankruptcy.
Yeah, the classic analogy of a drunken person stumbling around in a field.
Exactly. They move forward, backward, left, right, but eventually they either end up back where they started or just collapse completely.
Because the randomness dictates a regression to the mean.
And this is where my intuitive frustration really kicks in.
I get that.
I mean, I think about all the effort I see in the business world. The all-night strategy sessions, the massive intentional strategic pivots, the heavy investments in AI integration.
The blood, sweat, and tears.
Yeah, and some mathematician is telling me, yeah, all that. Mathematically irrelevant. Your company is just a drunken walker reverting to 0. That feels incredibly insulting to real effort and smart management.
It makes you question whether all the executive decisions, all the R&D, is just mathematically meaningless noise in a purely random system.
Which brings us to logic flaw number 2, the error of one-dimensional thinking in a high-dimensional world.
Let's unpack this idea of dimensionality. A classic random walk model, it often operates in a one-dimensional space. You can only move forward or backward.
Okay.
If a company were truly operating in one dimension, it's highly probable that, given enough time, it would regress to 0. But what is the reality of the business world?
The reality is that business competition is anything but one-dimensional.
Not at all.
It's inherently high-dimensional. We're talking about a landscape that changes constantly across multiple axes. I mean, think about geopolitics. A tariff announcement from Washington or Beijing can disrupt a global supply chain overnight.
Or think about regulatory changes. The sudden shift in EU privacy law or a new ruling on crypto assets can completely destroy an entire business model that was profitable just yesterday.
And then you have technological breakthroughs like the sudden emergence of generative AI, which can create a new market overnight and kill an old one.
And crucially, you have management quality and human decisions.
That is the critical omission. That's what makes these random walk models fail. They ignore the weight of conscious directional management decisions.
There was some data cited by Bloomberg in 2025 showing that the primary driver for the shortened average lifespan of S&P 500 companies isn't random regression or corporate boredom.
It's creative destruction.
Exactly. And creative destruction, as Joseph Schumpeter defined it, is not random.
No, it's the calculated, relentless process where new innovations and new business models actively and directionally kill off old, established industries.
Think about Netflix destroying Blockbuster.
Right.
Or generative AI disrupting traditional software services. That is a massive, directional, and specific technological change. It's not a random stumble. It's a targeted, intentional strike by an innovator.
So a company isn't just randomly walking around, it's actively navigating this complex, constantly shifting, high-dimensional maze. To call a collapse due to a failure to adapt to generative AI a random stumble, I mean, that's just lazy modeling.
It really is. It abstracts away the most important variables.
Yeah.
Structural change, directional innovation, and most importantly, human competence or incompetence.
Which leads us to that powerful analogy you came up with.
Blaming a company's collapse on random regression is like saying a person drowned because of the random movement of water molecules.
While ignoring the fact that they couldn't swim.
Exactly. They didn't have the management skill, the vision, or the capital to adapt to the high-dimensional changes happening all around them.
The one-dimensional model fails because it reduces a complex, adaptive organism driven by intentional strategy and human choice to
a mere rolling ball governed by a random number generator.
Look at the basketball analogy we use sometimes. When a player on the court suddenly starts hitting 70% of his shots instead of 50.
You don't call that random success.
No. You say he's evolved, he changed his diet, he hired a new coach, he focused on mental toughness. Companies are the same.
They don't just passively walk. They dynamically change their trajectory based on intentional, multidimensional decisions. They move in ways simple math models just cannot track.
So yeah, simple models just ignore the massive weight of conscious management decisions and structural changes, reducing a complex organism to a simplified statistical artifact.
Okay, so we've established that the models fail to accurately explain the winners and the losers. Now, let's look at the model's recommendation for the average person seeking career or financial success. The core advice is usually to focus on increasing your personal drift.
Your long-term positive bias.
Exactly. And to simply ignore the short-term noise, the volatility. Just keep moving forward, and statistically, you'll get there.
It sounds like motivational gold, but does this personal drift actually hold up against real-world disruption?
Well, let's test that optimism against reality. This brings us to logic flaw 3A. Structural disruption kills drift.
The model argues that skill, or a positive market bias, is an absolute long-term advantage. They point to market history, saying, long-term market returns always revert to GDP growth. Therefore, your skill ensures you capture that positive long-term bias.
But what happens when the very structures that define the long-term break down irreversibly?
We call these structural breaks.
And they are existential threats to the whole drift concept. What happens if the massive globalization trends that define the last 30 years just end permanently, leading to regionalized high-cost manufacturing?
Or what if demographics cause long-term structural population shrinkage in major economies?
We don't have to look far for an example. Just look at Japan's lost decades.
Right.
Due to demographics and other structural economic choices, their stock market never recovered its previous highs for decades. The expected positive drift, which was based on the history of, say, the U.S. or European economies.
It just vanished.
It vanished when the structural context changed dramatically.
Yeah.
If you had invested based on the simple model that markets always go up eventually, you'd have waited 30 years and still been wrong.
Wow. And let's bring it right into our current moment, 2024, 2025. We have to talk about skill half-life.
Yes. Think about the positive drift you spent years building up, say, mastering entry-level coding to efficiently write boilerplate web infrastructure.
The value of that specific functional skill has plummeted.
Potentially hitting near zero overnight, because generative AI can do it faster, cheaper, and often more robustly.
That's horrifying. You spend 5 to 10 years building up this powerful, positive, professional drift, and a structural discontinuity, an AI breakthrough, makes that drift irrelevant in 6 months.
You are starting from zero again, potentially in a race against a machine.
That is the terrifying lesson. Yesterday's positive drift can become today's liability almost instantly when technology creates a structural discontinuity.
But even if your drift remains positive, we run into logic flaw 3B. Volatility will kill you before drift saves you.
This is probably the most critical warning for the listener, especially those looking at high-risk investments or entrepreneurship.
I agree.
Most people fixate solely on the positive drift, the expected value, the average return, but they completely ignore volatility.
They treat volatility as just noise.
Just noise, when in reality, it is the actor agent of ruin.
So let's imagine a highly leveraged entrepreneur with a brilliant business plan. Their expected return, their positive drift, is 15% per year.
Fantastic. But they're highly leveraged. They borrowed heavily based on that expectation. And then a sudden, deep negative market shock hits them.
Maybe a surprise interest rate hike, a supply chain collapse.
An unexpected legal bill. Anything.
Even though your long-term expectation is positive, if that negative volatility exceeds your leverage or your available cash flow capacity, you are eliminated from the game.
That's the ruin risk threshold.
You might survive if you had infinite cash flow, but real people and real businesses have finite resources. You don't get to participate in the long term if you're wiped out in the short term.
I know a common counter-argument here is, but what about index funds? They always survive volatility.
That's a great challenge. And my answer is yes, index funds survive because they are diversified and have effectively infinite cash flow. The market can always replenish them.
But you don't.
Exactly.
Yeah.
If you're a specific business owner or an individual investor using leverage, that Keynesian quote becomes your mantra. You must survive until the long term arrives. In the long run, we are all dead.
The mathematical models assume infinite resilience, but real life is fragile.
And finally, let's look at logic flaw 4, the mathematically correct, behaviorally fatal strategy.
This is where the model gets ruthlessly, coldly logical, but completely misunderstands human nature.
Yes. The model suggests that in a negative expectation game, like a casino game, with a known house edge,
Right.
the statistically sound strategy for maximizing your chance of walking away with any money is to increase your variance, to make one large, big bet and walk away.
The mathematical rationale is that by condensing the game into one single step, you reduce the number of times you expose yourself to the negative expectation of the house edge and Markov chain process.
So mathematically, it maximizes your probability of leaving with a win. This is sound advice for a machine.
Right. But that strategy completely ignores the core psychological element. Human psychological addiction and cognitive bias.
The Financial Times tracked this extensively in reports on the gaming industry. Casinos absolutely love this high-stakes mentality.
Yeah, that they do.
Because they know a fundamental truth about human behavior. Very few people, having won that massive, life-changing single big bet, actually stop playing.
They get a powerful, massive dopamine hit. They feel invincible. They think they've cracked the code of randomness.
And what do? They immediately raise the stakes again and put their winnings right back on the table.
The logic loophole is that the model assumes a perfectly rational agent who, upon winning, immediately walks away and never comes back.
But increasing variance leads to greater psychological impact. The higher the win, the more powerful the subsequent emotional and usually irrational decisions become.
It leads to chasing losses, excessive risk-taking, and ultimately derailing that initial mathematically correct strategy through human hubris.
The volatility you survive mathematically immediately kills you behaviorally.
That was a powerful breakdown. What we've really established is that companies and people, they're not static objects like coins or balls in a jar.
No, they don't have fixed probabilities. They evolve. And the underlying statistical parameters change over time.
This evolution, where the rules of the game are constantly being rewritten, is what we call non-stationarity.
That's a bit of a mouthful. For the learner, non-stationarity just means what worked yesterday might not work today, and what works today might actively harm you tomorrow.
Right. It's why a static model based on last year's data is so dangerous. A basketball player is not a 50% shooter forever.
No, he might have changed his training regimen and now he's a 70% shooter. The model that says he's 50% is actively wrong.
Exactly. And the Financial Times noted in 2025 that in the AI-driven economy, static historical data is rapidly losing its predictive value because the productivity curve is experiencing a structural break.
The rules are changing faster than ever. So if the traditional drift skills like basic coding, data entry, or knowing a specific foreign language are now just infrastructure that's executed by a machine.
Where is the stable, long-term growth coming from? What is the new drift that won't hit a skill half-life of 0 overnight?
We looked at extensive reports from McKinsey, The Economist, and the World Economic Forum from 2025. And they all point to 3 high-value human dimensions where the positive drift is now stable and exponentially magnified by AI.
Okay, what's this first one?
Dimension 1, problem reframing and architecture.
This is absolutely foundational. AI is fantastic at solving any problem that is clearly defined. You give it the inputs, you define the constraints, and it delivers the optimized solution.
But the most valuable person in the entire loop is the one who defines the problem in the first place.
Right. You can train an AI model to optimize logistics for your 50,000 delivery routes, but if the logistics goal itself is fundamentally wrong,
like say you prioritize speed over safety or maximize volume while ignoring political risk.
the optimization is meaningless.
Totally.
Wow.
The Harvard Business Review confirms this positive trend. The scarcity is rapidly shifting from executors to architects.
And these architects are the people who can translate vague business problems like, we need more resilient supply chains, into AI executable frameworks.
Like, we need an agent-based system to dynamically simulate tariff impacts across 10,000 SKUs and provide 3 alternative production strategies. It requires deep business, philosophical, and technological insight.
But let's be clear about the risk here. Lacking technological depth is fatal. If the architect defines a flawed problem because they don't understand the underlying capability or limitations of the AI models they're deploying, it can lead to massive AI hallucinations or biased, dangerous solutions.
And the Wall Street Journal observed that Silicon Valley hiring is already shifting from pure engineers, who are great at building, to system analysts with philosophical depth, who are great at questioning what should be built and how it should interact with the world.
Okay, so that's dimension 1. What's number 2?
Dimension 2, high-stakes empathy and negotiation.
AI in 2025 can simulate emotion incredibly well. It can craft the perfect email or the ideal customer service response.
But that human-to-human biological connection remains irreplaceable, especially in scenarios involving deep trust or zero-sum negotiation.
We're talking about legal outcomes, sensitive medical diagnoses, or high finance mergers where billions are at stake.
In these high-stakes situations, AI provides the optimal strategy, the best plan, the data points. But consensus still requires human eye contact, subtle emotional signaling, and the ability to negotiate trust and compromise.
We've observed that humans have this sort of natural defense mechanism against what Nature magazine called non-biological empathy.
Right. When the stakes are life or death or massive wealth transfer, people need to look into the eyes of another human being to gauge sincerity and commitment.
That biological connection remains a stable source of human value. It's about trust architecture. We don't trust an AI to tell us the truth when our life is on the line, even if we know the AI is statistically more accurate.
Okay, dimension 3, AI orchestration and governance.
This is not just about writing a good prompt into ChatGPT.
Not at all. It's about being the conductor of an entire digital team of multiple AI agents, some analyzing code, some predicting markets, some drafting legal documents, and coordinating them with your human staff who are focused on the other 2 drifts.
It's a completely new type of leadership skill.
Let's break down this crucial skill shift for our listeners. Take technical ability. The old drift was writing high-performance code, which AI now excels at.
The new drift is auditing that AI-generated code for security flaws, compliance issues, and hidden logical backdoors.
The AI executes. The human governs.
And for information capacity, the old drift was collecting, organizing, and synthesizing massive amounts of data. Data collection itself was valuable.
The new drift is identifying deepfakes and finding truth amidst an unprecedented flood of information overload. You are the critical filter for integrity.
And finally, in leadership, you shift from managing human tasks and attendance to coordinating human creativity, the problem, reframing, and empathy with massive AI compute power. Your job is to maximize the synergy between the two.
The crucial analysis here, which connects back to that one-dimensional trap, is that AI acts as a multiplier.
So if your drift is positive, meaning you master these 3 high-dimensional human skills, AI leads to exponential growth. That 10% annual gain turns into 30 or 50%.
But if your drift is negative, meaning your skills are replaced by AI, execution AI accelerates your path to zero,
leading to rapid structural unemployment.
Exactly. As the Financial Times noted, it creates a ruthless winner-take-all environment. The higher you climb the skill hierarchy, the steeper your positive drift, the more AI boosts you.
But if you can't climb that ladder, your randomized walk gets a negative slope, and the 0 point approaches rapidly because the machine is just faster than you.
Right. Let's pivot and apply these critiques to the latest form of the one-dimensional trap.
The plethora of online tutorials promising one-click AI portfolios or AI-optimized investment strategies.
Yes. They market this as an upgrade using smart tools on smart data. But truly, it's just giving a high-performance magnifying glass to the blind man feeling the elephant.
You get the illusion of certainty because you have more data points than ever before, analyzed faster than ever before. But using strong AI without a robust, multidimensional logical framework means you are merely using expensive equipment to feel the same static side of the elephant.
And we identified 5 major logical blind spots here based on 2025 research from institutions like St. Gallen University, the SEC, and various financial data science journals.
Okay, flaw number 1, the retrieval gap, also known as the needle eye trap.
The common myth is that AI can instantly and perfectly read every word of every financial report, every single piece of data.
But the reality is much messier.
A December 2025 study from St. Gallen University found that while top AI models like Gemini 2.5 Pro are excellent at understanding complex financial logic, the what-if scenarios, 66% of their analysis errors originated from simple information retrieval problems.
So what does that look like in practice?
The AI often misses critical small details, like a nuanced explanation of a one-time loss buried deep in a footnote, or a key regulatory warning hidden on page 287 of a 300-page annual report.
It misses these details because the AI is often optimized for speed and summarization.
So the AI only retrieves good data because it only saw the good part. You think the AI is performing a deep forensic analysis, but it's often performing a surface-level retrieval, precisely picking out the shiny, attractive data points and failing to account for the crucial exceptions hidden in the fine print.
You've given the AI the whole trash heap, and it precisely retrieves the beautiful fake diamond.
Flaw number 2, overfitting and the static filter.
This brings us right back to our cover art analogy. AI models are masters at showing you perfect historical backtesting results. Look, this AI portfolio was up 70% last year.
That perfect historical performance is the high-tech Photoshop data. A study in the Journal of Financial Data Science in 2025 found that up to 70% of these highly optimized AI investment models failed miserably when confronted with non-sample data.
The actual messy, non-stationary future market.
Yes. Why? Because the model only learned to edit the past, finding the perfect, aesthetically pleasing features of yesterday. It learned nothing about adapting to the complex future.
It's the difference between memorizing the test answers and understanding the concepts. The AI memorized the perfect historical sequence of events, but the moment the market deviated slightly, it broke down entirely.
Because it had static filters applied to a dynamic world.
Flaw number 3, look-ahead bias. Prediction is not backtesting.
This is a quiet form of logical cheating that LLMs are particularly prone to. The model inadvertently knows the results of 2025 when it's being trained on 2024 data, even if the user tries to prevent it.
So Aper and Frontiers highlighted a dangerous tendency. Large language models, when analyzing market sentiment from news articles, often mistakenly treat post-event news.
The reaction to a competitor's crash, for example.
As a pre-event signal. This makes the backtesting look divine. It appears the model perfectly predicted the crash because it saw the subsequent news about the crash.
But in real-world execution, the model doesn't have tomorrow's headlines, making it behave erratically.
Flaw number 4, AI washing and data integrity.
You're training your AI filter on the data that companies themselves provide, but How honest is that data?
The SEC, that's the U.S. Securities and Exchange Commission, has issued multiple warnings about companies engaging in AI washing.
This is the corporate practice of heavily exaggerating their AI capabilities and integration in reports and press releases, specifically to secure higher valuations.
The Financial Times tracked this in 2025. They found that over 40% of large, publicly traded companies were deliberately optimizing their AI-related language.
So if your AI filter is set to select companies with high AI relevance or strong AI integration, you are, in reality, selecting the best PR writers.
And the companies that are most skilled at using AI to craft their own reports.
You've filtered for the best marketing, not necessarily the most innovative underlying technology or the strongest future drift.
Okay, flaw number 5. Alpha erosion or the crowded trade.
This is a mathematical certainty rooted in the efficient market hypothesis, and it undermines the value of any ubiquitous AI tool.
So if you and 1,000 other people use the exact same sophisticated AI tool to screen for the same set of perfect factors, say low price to earnings ratio, high growth,
what happens the moment the AI spits out the list?
Everyone rushes to buy those stocks simultaneously. The market instantly prices that newly discovered value in.
And the opportunity for excess return, what we call alpha, vanishes instantly.
When everyone's market correlation, their beta, converges because they're all using uniform AI tools and reacting to the same signals, the potential for individual outperformance disappears.
The equation for alpha clearly shows that when those systemic factors become uniform, your edge is gone. The better the AI tool, the faster its profitability is destroyed by its own popularity.
And finally, let's circle back to regime change.
AI models rely so heavily on past correlation. A has followed B for the last 10 years, therefore A will follow B tomorrow.
But when the rules of the game fundamentally change, think about the geopolitical supply chain shift post-COVID, or a sudden dramatic drop in the cost of AI compute that wipes out an entire sector.
Past quality data becomes misleading noise. The beautiful correlation breaks down, and the AI model, rigid in its reliance on the past, leads you right off a cliff.
So this entire discussion, from the drunken Walker model to the one-click AI portfolio, it all shows that these simplified tutorials are the highest tech form of the one-dimensional trap.
You're just looking at the data's photocopy, the static, perfect image, instead of the company's living body, which is dynamic and evolving.
We need to leave you, our listener, with the 3 ultimate cognitive black holes that these simplified models, whether they're based on a random number generator or a sophisticated generative AI, force us into.
Okay, black hole 1, the digital expansion of survivorship bias.
The AI, or the model, shows you the back-tested success of a strategy that screened for companies that survived the last 5 years. But the AI automatically and ruthlessly ignores the companies that had identical data profiles 5 years ago, but were wiped out by a random shock or poor leadership.
The Decision Lab found in 2025 that this kind of result-based backtesting leads investors to overestimate the success rate of a strategy by 4 to 6%.
The AI is just storytelling. It's selecting the winners, not providing a truly objective selection strategy. It only shows you the players who finished the game, making the game look far safer than it actually was.
Black hole 2, the loss of dynamic correction.
We keep coming back to the evolving player. Simple AI filters and models fail because they cannot spot structural change.
Imagine a company whose current reported quarter profit drops significantly. Linear, one-dimensional thinking and simple AI filters call this a decline.
They say sell, sell, sell. The drift is negative.
But the multidimensional truth might be that the company is strategically investing every single cash flow dollar into buying next-generation AI chips or launching a risky new division.
They're deliberately sacrificing short-term profit for a massive long-term advantage. Multidimensional thinking sees this profit drop as a dimension jump, the 50% player evolving into a 70% player.
The simple AI only sees the linear metric. It completely misses the strategic pivot.
And black hole 3, the prediction illusion.
This is that alpha erosion problem, the idea that you can find a repeatable, high-profit strategy using off-the-shelf AI tools is an illusion rooted in ignoring the adversarial nature of the market.
The market is not a puzzle waiting to be solved. It's a game waiting to be beaten. Your advantage has to be non-consensus and non-obvious.
And if the AI makes it obvious, the advantage disappears instantly due to mass adoption.
Our conclusion is clear. AI is the most excellent data organizer the world has ever seen, but it is the worst future prophet.
If you use AI without a robust, multi-dimensional logical framework. Without incorporating those 3 human drifts we talked about, you are simply using more expensive equipment to feel the same elephant.
And you still don't know if you're holding a trunk or a tail.
Wow, that was a brutal but absolutely necessary logical dissection of some very popular concepts.
I really hope this helps you, our listeners, understand the limits of these popular models and filters.
Mental models and AI filters are powerful tools for efficiency, but they are not dogma. They provide data and efficient processing.
Your goal should be to use AI to exclude what you absolutely should not buy, to filter out the companies or career paths with serious detectable flaws, not to decide what you must buy.
Refuse to be a high-tech blind man.
And we want to make it absolutely clear, our discussion today is objective. It's aiming only to provide facts and encourage critical thinking about these logical constructs.
We are simply taking those popular mathematical constructs and showing you the structural flaws beneath the hood, urging you to think multidimensionally in your career and investment choices.
That's our mission here at Sip&Talk. Thank you so much for joining us for this intense logical breakdown.
Don't forget to subscribe to Sip&Talk wherever you listen. And while you're thinking about multidimensional reality checks, check out our old friend Mickey's YouTube channel, Mickey to Life, for some fun memes and the latest travel vlogs.
We'll catch you next time.